Okay, we're gonna go ahead and get started. Thank you all for joining us. My name is Rafael Cestero, and I have been asked to moderate today's panel on naturally occurring affordable housing. And you know, as usual, for all of us in the affordable housing world and in the housing world, we have to pick and name things. So we chose naturally occurring affordable housing. And you know, if we all got in a room together over a cocktail and we had a conversation about what does that actually mean, I think we would probably all have different opinions of what that means. So we're going to try today to have a conversation about what is naturally occurring affordable housing, market affordable, some people call it, and what that looks like and what strategies people are using around the country to try and stabilize that stock and keep it affordable. We have a terrific panel of people who all have been practitioners in the affordable housing community development space for many, many years. I'm going to let each one of them introduce themselves briefly as they come up. We have decided to structure this conversation around 4 case studies. So each panelist will talk for a couple of minutes about a specific project that they work on. And then at the end of that, we'll come back and we'll have a discussion about some of the higher level policy, program, business implications for the industry when dealing with this housing stock. And then we will also open the floor to questions and engage all of you in the discussion. As just a table setting set of comments, you know, I run an organization in New York called the Community Preservation Corporation. We're a 44-year-old not-for-profit affordable housing community development lender. Our roots are in this thing we now call naturally occurring affordable housing. It was really about stabilizing apartment buildings in New York in the 70s and 80s and ensuring that they were quality places for people to live. Obviously, the rental housing market in New York and around the country has changed dramatically, and it has put a series of other pressures on this housing stock that are less perhaps about housing quality and more about maintaining its level of affordability and ensuring that we have you know, an ongoing market housing stock that people can live in and is affordable. And I think, you know, it raises a series of questions that we'll come back to. You know, I have, you know, I've lots of conversations over the years with a variety of different people, and one of the things that you know, this panel will talk about and that the work that each of these folks are doing in this space brings up is, you know, can we really solve the rental housing affordability challenges in our country, one regulatory agreement, one government subsidy program, one low-income housing tax credit deal at a time? Or do we have to try to find other ways to stabilize the housing stock, preserve the market's role in providing moderately priced rental housing as part of that strategy? And then what is that sort of, what are the impacts of that, and how do we ensure that affordability is maintained? So that's what we're going to try to address in the panel. We're going to try to make it somewhat informal and conversational. And like I said, after we go through the case studies, we will also engage all of you in the conversation. So we're going to jump right into it, and we're going to start immediately to my right, and I will ask Rachel to introduce herself, and then she'll talk to you about her work in Minnesota.
Yeah, good afternoon. I'm Rachel Robinson. I'm with the Greater Minnesota Housing Fund, and we're based in Minnesota, in St. Paul. And my role there is to run our NAAHL Impact Fund. We are a CDFI. We've been in business for over 20 years, lending and doing grant making, program services, technical assistance, tax credit syndication across the state of Minnesota. But a couple years ago, we found ourselves in a very unique place as a state, and each region, you know, is approaching their NAAHL challenges. We're approaching ours from within, as well as partnering with everyone here to address the challenge. But Minneapolis, St. Paul, 7-county region is absolutely in crisis in the loss of NAAHL. We still have a lot of this housing, this garden style, 1960s, 70s built apartment stock that is renting for what for us is affordable. It's like $1,200 2-bedroom. And we have very high median income. Our median income for a family of 4 is over $94,000. And we have very, very low vacancy in rental housing, especially in the NAAHL market. So, of course, values have also been pushing up. And if you read industry magazines on investments, then you are reading that Minneapolis is the #1 target right now. And so a lot of the sellers are getting into the game, and they're selling property. A lot of family owners with less than 1,000 units have decided this is the time, and they're going to move, and they're going to sell their portfolios. So we came up with, a couple years ago saying, let's have increased impact. Let's do 2,000 units in the next few years, in addition to everything that our national partners can help us do by filling the gap in the equity market. So bringing in true equity that is at-risk capital. We pair with mortgages to buy this stuff, keep it affordable with our developer partners. You're going to see this deal, that's my case study, twice, because it was so big that no one party could do it alone. A family chose to sell out of their 770-unit portfolio in 10 properties. Individually, each one of them would have been very hard to do as NAAHL because they were on the expensive side for the small size. But grouping together with 2 of the partners here, we participated in buying the whole portfolio, 1 developer, 1 closing. We did not partner, but we split the portfolio up in a way that the seller did not see the transaction as risky. They did not see that we were going to have more than 1 investor, more than 1 deal until the day we signed the settlement statement, so that it was a nice, clean transaction on their side. They really wanted this thing to go in 1 day. And we did it. We did it on a short timeline, considering how many units, and that had been managed with kind of like a QuickBooks-style management company for a while. So we got in there. Now, this is a pretty significant lift just for us. We had $25 million in June of last year, and we brought almost $8 million to this deal. And so it was a pretty large chunk of our capital. But you'll also see we had a nonprofit operating partner, and we have them, as most of the funds do, bring at least 10% to the deal. And that's a big lift for them at almost $1 million in the deal. And so this facilitated a larger transaction. These are pretty funky looking buildings. The pictures are small, but they're wood, vertical siding. But inside, these are spacious floor plans. These are great school districts. We are in really good locations where we're seeing a lot of home buyers who are young people, young families, and rents are pushing up, and any other buyer would have upscaled these apartments and rented to a different market. And so, but for our involvement and our ability to pull this coalition of folks together, we would not have been able to do it. So I'll move on. I have 2 other slides that I can come back to just on how, as a regional fund, we do this work. But
okay, let's start with the confession. I can't see a damn thing. I can't see any of y'all. I can't see my slide. The lights on us, it's like an interrogation. So if you want to ask anything, what I made last year, whether I've cleaned under the bed in years, go ahead, because I will tell you anything. I'm Ann McCulloch. I'm CEO of Housing Partnership Equity Trust, and I'm a houser. So that's my confession moment with these lights, right? And I've spent my whole career bringing different tools to bear to try to solve the problem of affordable housing. And one of the fun things for me in this current role as CEO of Housing Partnership Equity Trust is I'm using all the tools I think I've used in my career. Whether I was at FHA, whether I was representing nonprofit groups, whether I was at Fannie Mae. We're bringing them all together right here. And Housing Partnership Equity Trust is a public purpose real estate investment trust that was founded by a nonprofit, really tax credit developers from all over the country who knew they didn't have the tools they needed to serve their communities if they were only going to be using tax credits today, because there are a whole bunch of people who are falling out of that service. And we needed new tools to come to the table. And the biggest tool you need is equity capital, because NAAHL properties transact like the hottest house in the hottest neighborhood in your city, right? They sell in 60 to 90 to 120 days. You got to come to the table with 20% down. You can't have any funky contingencies. You got to be able to underwrite, have a business plan, and go. And so my partners, my nonprofit partners, realized that's what they needed. They put us together, and then they went out and got institutional capital from a number of banks and foundations. And in the 5 years we've been in business, we've acquired about 3,000 units of housing all over the country in 15 properties in a range of markets. But they all look a lot the same, and they look like the deal she just talked to you about, and that you're going to hear in more detail from the other guys, because we're all buying the same stuff. It's garden apartments in good communities that offer the things that families need to succeed. And what is it? You got to be on the bus line. You got to be in a good school district. You got to be near grocery stores, because that's what a household needs. And if they don't have that, life falls apart. And so we're targeting all those garden apartments that today are just barely hanging on to affordability, and we're bringing a lot of discipline to them. The property I've got up there, we were the neighborhood disgrace, okay? This is in Newport News, Virginia Beach, the Tidewater. Good property, but the owners had lost interest. We had really become the open-air drug market, conveniently located to the elementary school and the public library. No one around us liked that property, and the owner had lost site control. The swimming pool was all chain fenced up and had broken things just stuck in it. Truly, it was a problem. It was subject to a use restriction that was somewhat ambiguous and confusing from an old city program that required that the property serve as workforce housing. And we had motivated sellers who really they wanted out, they had it. So we were able to go in with our partner, CPDC, one of our nonprofits, and put together a business plan that met the city's needs for workforce housing. Raised rents about 2% a year for 5 years is our typical business plan, and it was for this case. And do rehab enough to bring it back to health as a property, get site control, put up some good fences, and start recruiting, frankly, tenants that you wanted. It had become the housing of last resort for people that no one wanted to be neighbors to. And we're not talking about economics. We're not talking about any form of demographics other than these were people who had become a problem. And people were fleeing the property. So we started re-tenanting it with our typical tenant, who is a working mom. She's probably a home health care aide, making 51% of very immediate income, and has 2 kids. And depends desperately on this housing to succeed. And that's who we recruited. We were able to raise occupancy from about 79% to in the high 90s. And because we were able to deliver really significant returns through the discipline we brought to the property, we were able to do a cash out refi within 2 years, put a lot of that money back into the property, and then distribute some returns to our investors. As a REIT, we're a perpetual life vehicle. So our plans for our portfolio are really dependent on the property itself. We don't have an 8-year cliff event where we have to sell everything or refinance everything. But each property is assessed for what's the best outcome for that property and that community, and also for how we'll be able to return money to our investors, because investors need to know that they will get a fair risk-adjusted return for investing with us. Turn it over to y'all, and then we can
Sounds good.
Uh-oh.
Uh-oh, that's very tiny.
Well, there we go.
Before I jump into the actual deal, I'll just give some overview on BMO Harris Bank. We're part of BMO Financial Group based out of Toronto, formerly known as Bank of Montreal, $744 billion institution. BMO Harris Bank is the $109 billion sort of U.S. personal and commercial banking business. Super regional bank based in Chicago. We also have a large footprint in Wisconsin, in the Twin Cities, parts of Florida and Arizona, as well as Indianapolis, and a little bit in Kansas. I'm part of the Community Investments Group. I run that team. We are housed in the bank, within the commercial bank, as part of the corporate finance team. So all things sort of sponsor related, private equity related, which really helps provide us some of the flexibility and the creativity, if you may, with what we do for CRA investments and achieving the CRA investment test. We commit about up to $140 million a year in new commitments across multiple asset classes, CDFIs, LIHTC, SBIC funds, these real estate funds, and some direct real estate investments, which I'll get to in a second. LIHTC has become now only maybe about 42% of our total exposure. We have really tried to focus on driving more cash-based returns, which is where some of this begins to fit in for us. Sort of the cash-based equity investments we make are now to about 48% of our total exposure. Within that, you have sort of the real estate funds, and the real estate funds are in basically two buckets. They're either the owner-operators or they're other intermediaries, or it's kind of pure investment funds. And we've invested in the Vanith, we've invested in Enterprise, which you'll hear more about, and we've also invested in a few other similar funds that do NOAA. We also invest in non-housing real estate funds, whether it's Turner Agassi Charter School Facilities funds, some retail funds. So we do quite a bit to kind of move towards the cash-based piece. The NOAA and the growth in NOAA has provided us some great opportunities, not only from a fund level, but also from a direct investment level. We've done 4 direct investments, 2 as mezzanine, 2 as preferred equity. And in each case, we've had a great partner, and we've had multiple partners to help support the public welfare case. I think you've heard a little bit about public welfare earlier today, and I think Jack Ronkowski talked about the confusion between having sort of public welfare versus CRA and CRA investments versus lending. And the one transaction that we have up here in terms of the direct investment, we partnered with a fund that we were already an investor in the fund. When we invest in a real estate investment fund, the first thing we say is, are you open to co-investments? Because we've gotten comfortable making direct investments. The great thing about the direct investments and some of the non-tax credit based fund investments is the yields are higher and they're shorter in duration, so they help support the overall portfolio mix. We can continue to do the CDFIs and the tax credits, but looking for sort of higher yielding, shorter term, and instances where we can get sort of higher exposure from a sort of marketing or branding perspective. The transaction up on the screen is one you've heard about earlier, the portfolio acquisition. We participated in just a portion of that acquisition. I think it was 6 properties. And Enterprise, we invested in their fund 2, and the first thing we said, are you open to co-investments? If you find bite size that is too big for you and you want a co-investor, please give us a shot. And this particular transaction was the right size for us. I did not put any numbers up here because I didn't want to run afoul of any of my partners or the seller.
You wouldn't be able to read them.
Right, that's true. But it was a $4 million commitment for us. And it gave us great comfort. Obviously, if you've underwritten the fund itself, that gives you some comfort that you're going to be in the deal anyway if that fund closes. So you know you're going to have some exposure to it, but you do kind of take your time and get your arms around the specifics of the transaction. And you look for probably slightly higher return because you're going in direct on that co-investment piece. But it supports your sort of economic decision, but it also supports the public welfare investment component of it, which I know a lot of banks, oftentimes, whether you're regulated by the Fed or you're regulated by the OCC, sometimes I hear that the discussion is not as clear as it can be. I must admit, we're very fortunate. Oftentimes, I will send opportunities directly to the folks at the OCC and say, please take a look at the legal documents. Here's the structure. Here are the partners. And they will opine and tell us, well, if they include this in the LPA, then we think it will make sense. So it's sort of getting out ahead for some of those things, including this transaction here, which we've received credit for. So we're again, in direct, and we're also in the funds. Most of the funds are national in scope. We got a newer fund that we're looking at. Jack Mikowski was here. I think you'll hear from Stacy later, but they have a fund that they're launching to do mezzanine investments in high cost areas in Chicago. And so we're looking at underwriting that to put cash to work. Again, it's shorter term than LIHTC and higher yielding, and will have an impact in the community development world in Chicago.
Scott?
All right, good afternoon, everyone. I'm Scott Hoekman with Enterprise Community Investment. As many of you know, Enterprise has been involved in delivering capital and financial products for affordable housing and community development for many years. Low-income housing tax credit syndication, mortgage banking through Bellwether Enterprise Real Estate Capital, which does Fannie, Freddie, FHA, market rate, affordable, and so forth. New markets, CDFI, and so forth. But a few years ago, some of our development partners, nonprofits and for-profits, really came to us and said, you know, and you've heard of, and you're aware of what's going on in these markets. You know, there are these properties, they're at risk of being lost, converted to market. They're not restricted, but they're serving really that similar population and similar incomes that as who we're serving with our dedicated affordable housing, our tax credit housing. These things transact very quickly, and we can get debt. Sometimes we can maybe get a little bit of public lower cost debt, but we really need equity in order to fill the gap and to be able to move quickly and acquire these properties. And that's really what led us to start exploring what we branded as our multifamily opportunity funds, which we're actually going to have to change the name of now that we have opportunity zones and opportunity funds and so forth. I don't know if you've been talking about that, but very confusing. So our structure is a closed-end real estate private equity fund structure, which is investing with developer partners on a joint venture basis. And we've raised a series of 3 funds to date with a range of investors, including BMO Harris, great partner of ours in these, other banks, insurance companies, pension funds, a couple of foundations, some high net worth individuals, and even a couple of our development partners, nonprofit development partners who've had some capital that they wanted to deploy in a way that would have a greater impact. The most recent fund that we have closed and are investing now is $110 million. And together, what we've deployed so far is into 64, with these funds, 64 apartment communities, about 8,000 units of affordable and workforce housing. That represents about a little over $700 million of total capitalization. And we're targeting, with our partners, 3 types of properties in these funds. So it's not all NOAH, and we still haven't had a chance to really debate that, whether that's a good title for it. But some of these are, probably half of them are unrestricted or market affordable properties, as we've been talking about. But this fund is also helping partners buy older, year 15 or thereabouts tax credit properties, as well as some Section 8 properties that also need reinvestment, better management in order to preserve their affordability, but they're not really quite ready yet for the full recapitalization with say, a tax credit resyndication. So we've really built that mix into our funds. As I said, it's a closed-end structure, 8 to 10-year funds, and so that does require that these, it's not perpetual. These deals do have to be, refinanced, disposed of, bought out by the joint venture partner, or, and this is one we're seeing quite a bit of, the plan being to dispose of them into a tax credit partnership. You know, when we talk about, and I hope we get more into it, you know, okay, what kind of ensures the affordability here? Because if you're talking about what is now unrestricted property, you know, we and our partners are buying it. We're self-imposing, essentially, in a lot of these cases, affordability restrictions during the hold period, but it's not the same thing as having a 30-year regulatory agreement that's locking in that affordability. So we see it as a good outcome when these properties are then rolling into a tax credit partnership, although that's not, you know, a panacea either, in part because it then does, it maybe can't serve quite the same range of folks. I have a case study up here of one of the properties that we acquired. This one's actually in Texas, 172 unit property. Our joint venture partner here was a housing authority that's done a number of these acquisitions. And one strategy that they've used and that actually some of our other partners have used with deals in this fund is to either ensure affordability or even to target more deeply in a couple of the tax credit deals by going and getting a property tax abatement that wasn't already there. So a couple of the tax credit properties that are in the fund, which were with a very strong for-profit joint venture partner, so they were serving 60% of AMI, but with the tax abatement committed to serving a certain number of units at 30% of AMI, for example. And so, you know, each property has a business plan, and that business plan may be around improving operations, but it also may be, you know, strategies to, you know, to keep that affordability, like putting a tax abatement in place, doing a green retrofit to bring down operating expenses. A lot of these properties are undermanaged, and bringing in better quality property management can make a huge difference. And really, you know, one of the terms you hear in this space is sort of value add, and what does that really mean? And I think for a lot of the private equity that's out there, value add means you kick everybody out, you really upgrade the property and turn it into something that's affordable at a very different price point, and really isn't geared toward the people who live there now. So I think with these properties, value add means something very different. It means, what are those folks that are living there today willing and desiring to pay for in terms of, you know, a renovated kitchen? Will they pay $50 or $60 a month more for a renovated kitchen? Would they like that? And those are the kinds of upgrades being made to the properties. This property, the plan here for the exit is that the housing authority plans to redeem our interest in the property or buy us out, and we've given them the right to do that, so the property doesn't need to be sold. This one is not, and there are others like this, is not a good candidate for tax credit partnership because the 10-year chain of title was broken, and there are units, quite a few units that are over 60% of AMI. But as I was saying, there are other properties where the plan is to go into a tax credit partnership, and we've done that already with one property in the fund. So I'll stop there.
That's great. Thanks, Scott. So I mean, you kind of did a good job of merging us into the question that I really want to start with, which is you know, this question of regulatory agreements, government subsidy or not, and how do you ensure the right outcomes that we're striving for with this kind of endeavor if you don't have government subsidy regulatory agreements in place. You know, in New York City, CPC, we are the owner of, in a partnership, a joint venture partnership of 6,300 units of naturally occurring affordable housing in the South Bronx, in a very rapidly rising rent environment. And we have managed that property over the last 15 years, focused on occupancy rather than on rent increases. And our average rent increase over that period has been, as Ann talked about, in the 2 to 3% range, where rents across New York have been rising, double, triple, quadruple, and more of that. And it's been a very successful investment for us. And we have maintained affordability at that property without any regulatory structure at all existing in those units. And so one of the things that I think about a lot when I think about this issue of this housing stock is what's replicable. And I fundamentally, truly believe, to paraphrase my friend Chuck Lavin, who's here in the audience, if our only tool to solve the rental housing affordability crisis in this country is government subsidy and regulatory agreements, we've lost. So I'd like each of you to kind of talk a little bit more about how you think about that challenge, because it's a real one. And how do you think about who the owner is? And the only other caveat that I'll throw in there is one of the things that Rachel talked about, which I know is definitely happening in New York, and I think it's happening around the country, is who owns the rental housing stock in our country is changing. And the influx of private equity has changed that dramatically. And generational ownership, family ownership, people that are owning for the long haul as opposed to the short haul, that dynamic has changed a lot. And for those of us that are interested in the affordable housing, I think, and interested in this issue of the naturally occurring stock, I think we need to grapple with how do we ensure that the tools that we're using aren't ending with the same results because of how the capital is structured and how the deals are structured. So, I'd like us to kind of debate this question of how do we know that what we're doing is really ensuring affordability if the answer isn't government, government, and government.
Yeah, I'm happy to start a little bit. Just one of the powers of being a place-based CDFI, for those of you who are place-based, is the power of subjectivity, that we know what a win is because we're immersed in the community. We know every one of our 80-something suburban cities, and how desirable those places are, how they've changed over time, where they're going. So when we think about affordability, and one of the things we debated in getting our fund up and going, we knew we wanted to prevent displacement of the people there today. We knew we wanted to rent stabilize, but we also knew we were going to be competitive on price, so we were going to have to do some higher rent units sometimes. And we're going to work with for-profit buyers in addition to nonprofit buyers. And so we want to make sure there are incentives, but also some strings to tie to make sure that they stay in line with our affordability covenants. So we are a longer-term investment vehicle. We're not in perpetuity because it's an equity fund with an exit payment, but we have a 10-year investment term and an additional 5 years of recorded use agreement that we expect compliance with. But even out in the public sphere, and something I'm sure we all experience, that talking to city councils, talking to people in the housing industry, 10 years is disappointing. And 10 years is a long time for an equity fund in NOAA. And for the affordable community that's gotten some of these use agreements up to 60, that's a little bit of a letdown. And I think that one of the ways that I handle that and think about working in our local community on these things is that it's a mandate to keep going and inventing new tools and continuing to fund tools like equity and keep our mortgage products, flexible enough so that we can refinance these affordably, so that we are not going to have to, upmarket them when we get to the 10-year mark in order to meet our expectations and our investors' expectations.
Sure, I'll take it on too. And I have a lot of different answers on this. My own entity's legal documents restrict what we invest in. We are in the affordable housing business, and we have to stay in the affordable housing business. Although, as Rachel said, there's nothing wrong with mixed income, and mixed income is often very healthy and productive in our communities. But the type of mixed income we're looking at is 50 to 90% of area median income, not 50 to 150. So We're catching families that are falling out of home ownership and are on the way down, and we're helping families who are on the way up. So that's the mix we look for. Our nonprofit partners have their own 501c3 and 501c4 restrictions, which require them to be in the affordable housing business. So our governing documents restrict what we do, but we don't add any unpaid for use restrictions on anything. Complexity is not our friend. Complexity has cost. And so adding a use restriction, unless someone has given me money to pay for that, is damaging to my tenants. Now, about 30% of our portfolio does have use restrictions. They were year 15 deals. They're deals that some local jurisdiction has given us a really good soft subordinate financing on. So we've added it. But otherwise, we're managing those properties cost effectively to serve our target tenant base without additional bells and whistles. And we think that's really one of the only ways to go, because I hate a 60-year use restriction. It's magical thinking, right? We have no reason to believe that property is going to be physically sustained for 60 years, that there will be enough subsidies to keep that thing alive. We're fooling ourselves when we put a 60-year use restriction on a property built in 1982. It's delusional. But it's not delusional to think about the long-term health of the building and how you'll continue to keep that health alive. And that's where you talk about, you know, in year 10 doing a tax credit resyndication, because these things are old. They're going to need some work in 10 years. So, but you're always looking at what that next set of tools is that you're going to bring to the table.
For us as a bank investor, things normally come in two buckets when we look at our direct investments. First of all, the ownership structure, we're always looking for some owner that has a sort of mission orientation to investing in this space. They have a history of it, they're committed to it, and it's pretty much part of their overall charter to do that. I can think of two cases, and one highly subsidized transaction, but not enough subsidy, another no subsidy in it, but the ownership structure was critical. We've done two mezzanine loan transactions. One in Twin Cities we did to a new construction 80-20 transaction. We did the mezz loan to the market rate component, and that cash was used obviously towards the entire development as things were checkerboarded in, beautiful development. And our public welfare sort of supporting information was that, but for the market rate component, the tax credit component would not happen. So that was the argument there. Highly subsidized deal. The ownership structure was a developer committed to the space that obviously had tax credit in it. But we also partnered with another investor, and that's LISC, my former employer throughout the 90s, was actually the lender to the deal. And from a sort of underwriting standpoint, another component that helped us get comfortable is BMO is providing the debt on the transaction as well. My colleague, Pam Daniels over there, you can raise your hand, Pam. Her team did the tax credit equity bridge and the first mortgage debt on the transaction. So that's one. Another transaction with no subsidy on it, smaller in nature in Chicago, CHA became part of the ownership structure to actually do a cash out refi for a private owner who was going to be the equity provider in a deal adjacent to that that was going to be mixed income. Their cash out had to go to the equity for a mixed income transaction around the corner. But we did a straight mezzanine loan to that deal. And with CHA and the ownership component, that really helped sort of support additional comfort for us, and the fact that the cash out was required to go to the mixed income transaction, which has LIHTC in it. So there are a couple different ways we come at it. Who's in the ownership structure, and who can we partner with as well?
So a couple of things. First of all, our funds do have, and our investors expect it, that we're hitting affordability targets. And like I said, some of it is dedicated affordable tax credit or Section 8 housing, but we also have the market affordable or NAAHL housing. And But we have to hit a certain number of those units affordable at certain levels, and the banks in the fund are getting CRA credit, and so the 80% of AMI is very key for that. It's a federal definition of low income. And one interesting nuance there is that when we first started out, the way of looking at that was what's the rent setting on that? Is it set at regardless of what the tenant's income is, because you're not really income certifying like you would in tax credits, are you setting the rent at a level that would be affordable at or below 80% of AMI, which the overwhelming number of units in this portfolio do. One of the banks in the second fund came to us and said, and I forget which regulator was telling them this, that they wanted to know that the residents were hitting sort of within that definition, and we're not doing income certifications. However, they were willing to accept that when you are qualifying a renter, you are looking at their income. Can they pay the rent? And so you do have some income information, and that was acceptable. And so those are in there, and we're not recording regulatory agreements on the land in these NOAA properties, but the operating agreements do impose those affordability targets. But again, that's for the period of the hold. I think it sounds like we could have a good debate about long-term use restrictions. I personally would disagree that it's delusional to think about long-term use restrictions. It's
Optimistic?
You need to have, this is not a binary thing. It's not either it's not that the use restriction has to be a lockout on recapitalizing the property. That's what the problem is.
Right.
But there's got to be ability to recapitalize any property over time. But to me, there's nothing about the length of the use restriction that should lock that out. It's if the agency is saying, you can't do anything during that time period, that's when I would agree it's delusional. And we like the others have said, we look at who are we dealing with? Are these folks who are in the affordable housing business? And even we do have for-profit joint venture partners, but even they are ones who they do a lot of affordable housing. They do this. These are sort of long-term participants in this space and in affordable housing that I think is, in some ways, at the end of the day, even on the dedicated affordable housing side, is a huge component of whether this stuff really stands the test of time. The last thing I'll say is that while we could fret about the fact that, wow, we don't have a long-term lure in these deals, and how are we going to make sure they're affordable, I would argue that we got a problem that's even broader than that, which is, and maybe this goes back to who are we dealing with in terms of how do we, and this is where this fund came from for us, how do we get some of these properties into the hands of the preservation owner, the preservation-oriented buyer? Mm-hmm. And I would argue that we have the same issue with tax credit housing. As some of you may know, Enterprise, through our development arm, Enterprise Homes, was successful, closed on it last year, in purchasing a portfolio of 43 tax credit properties, totaling about 4,200 units in the Mid-Atlantic area, mostly in Maryland here. All of them tax credits. It was a wide open bidding process. Probably half of you in this room were somehow involved with that bid. I don't know, but it was extremely competitive. It ended up going off for a very high price. This was for a mix of fee simple ownership as well as GP interest ownership in these tax credit properties. But there's no question that there were buyers out there that we were competing with who were looking at these portfolios and saying, okay, when is the extended use period up? What am I going to be able to flip them to market at that point? Yeah. And they were building that pricing into their model. At best, that's at best. At worst, they were saying, well, who's really going to know if we blow off the lure at this point and start renting to people, right, new people at market rates? Or maybe we'll just start taking these properties to a qualified contract, perfectly legal way within Section 42 to take these things out of affordability after 15 years if someone can't meet the over market price that's stipulated in Section 42.
That's right.
So I think that this issue, this is America. We're
You sure about that?
We're not.
I'm sorry.
Q&A. You know, and so I think that these issues around, we can't just sit back and say, well, you know, we got a lure, you know, all is well. I mean, it's good for as long a period of time as you have it for, and as long as there are ways of recapitalizing properties over that time period. In that sense, public housing, it's crumbling, but it's the only source of affordable housing that is like, you know, locked off as affordable in perpetuity. So I think these are big issues in terms of how we really ensure it.
So I think this was a great, all of you had really great thoughts and ideas on this. One thing that I want to just poke on a little bit more, because each of you said it in one form or another, and it's something that I happen to be a firm believer in. And when I talk about this in New York, I get a lot of people rolling their eyes because they're not sure that this kind of owner is out there. And that is the sense that you all have that one of the biggest components to how you ensure that these units are being maintained as affordable is who's the owner? Who's your partner? Who are you investing with? Who's the operator? And what's their long-term strategy? What's their business strategy for doing it? At CPC, this is something that we think about a lot, who we lend to and how we do our investing. Who's the owner? What's their business plan? What's their strategy? How do they think about why they're making this investment? And I believe, and each of you quickly comment, I believe that across the country there still are real estate owners, multifamily owners, who are in it to own the real estate for the long run. They're not in it for the quick buck. They're in it for ownership. And so the real question is, to your point, Scott, how do we create the tools, which I think each of you have been doing, to drive this kind of housing into their hands as opposed to other people's hands? And so just give a sense of kind of your view of the demand and appetite and the availability of good owners in the markets that you're working in and around the country that want to do this. Do those people really exist, except for, you know, some of the nonprofits and some of the other, you know, more light tech oriented for-profits? Anybody want to?
Yeah, I think I have a twofold answer to that kind of question, because there's one, the who's doing it. We don't buy real estate, we partner with developers who are buying real estate. So if they're not going to take these risks and they're not going to get out there and bid in these really heavy bidding processes, where we will go nowhere with an equity fund. So we're fortunate to have two nonprofits, large ones, in the Twin Cities who are all in, who've done the strategic planning, they've built the infrastructure, and they're doing the buying. I also have a number of developer partners who I work with who are family companies, who are in second and third generation. It's kind of the magic fit, and can look out 10 and 15 years to a long-term hold and see that as a good way to do business, because they self-manage. If they used other private equity, because they don't have enough cash to do this over and over, if they used other private equity, they would need to put a construction team in there, change the marketing plan, you know, be aggressive. They'd be taking a lot more risk, and they can just not do any of that and keep it affordable. And a lot of them are familiar with affordable products and be a good partner. And they actually know how to manage this stuff very efficiently, and so that has not been a learning curve. But we continue. One of the things that I work on constantly, because I'm in one market and I do this one thing in one place, is access to these deals, especially off-market, before they are brokered. And we have not figured out a magic formula for that. Some of the nonprofits really are good at working their relationships because, you know, people do care, and when they start to see this issue as, you know, about our economy and our society, they can get sympathetic. But there's a great documentary, by the way. If you like to watch hour-long housing movies, our local...
I do.
I do.
Our local
Anybody
public
else?
television station called TPT, Twin Cities Public Television, It's streaming online, and you can look it up, watch it on the plane. It's sold out.
Don't stream it now. We're still in the
We're in
middle
the
of our
session.
panel.
Crash the router. But we have all these suburban
The title,
it?
quick.
Oh, I'm sorry. It's called
I'll write this
Sold
down.
Out. Sold Out. And
Sold
you
Out.
just Google
Sold Out.
TPT Sold Out. You'll find it. It's really very, very good. And it's actually a good film to show to somebody who doesn't understand why this NOAA thing is a problem, because it's the human impact and so forth. But it's those suburban cities where this film is set in the community of Richfield, which is where the Best Buy headquarters is. Where the film is set, it's the suburban cities where it's hard because it's fractured. But each one of our suburban city councils, especially those with newer, younger councils, are taking forward these policy agendas around rights of first refusal, tenant protections, and using their tools with the school districts and rental licensing, everything that they can throw at it to help talk to sellers, potential sellers and landlords about the benefits of preservation buying. And they're coming up with incentive programs to make that work. It's hard because we have 80 larger suburban cities. And there are 20 some of them who are each taking forward these platforms. So it's policy at the very local level, but it is, it's what we've got right now and it's working.
And I absolutely believe who owns matters. In our platform, I am partnered with large national and regional nonprofits who are in the housing business. And this is their deep expertise, and their communities are the places they know. So we can get off-market deals. We often get tax abatements. And this is all they do. But I also have a national team of really hard bottom line commercial real estate experts who are, we're providing technical assistance every day to our nonprofit partners on, best-in-class marketing techniques. Because guess what? You market a NOAA property differently than you do a tax credit property, for example. And so we have a good relationship where they bring their deep local knowledge and we bring our hard bottom line knowledge. But there are some also very good for-profit owner-operators in this space.
That's right.
What you need more than anything in this space is a commitment to affordability and real expertise in managing these properties, because there are no nickels that you can waste on this. The other thing we haven't talked about is that there are many owners in the affordable housing space who are bad owners and who use tenant abuse as their business strategy. I don't think there's a property we've bought that didn't have 6-month, year-old, 18-month repair tickets in individual units where owners were happily not replacing the hot water heater. We're happy with the ceiling falling through in the bathroom because it worked for them as a business strategy. They were stripping everything they could out of those properties at the expense of their tenants. So that's the bad news story of what we all run into. But you talked about a couple of for-profits you've done deals with, and they do good work. But again, it's what's your commitment, who do you intend to serve, and do you bring the expertise to the table?
One of the ownership classes that I think there's an opportunity for, at least in Chicago, and I'm sure some other cities, are the sort of mom and pop or individual entrepreneur owners who historically have been in apartment buildings. The apartment building business, whether it's 8 flats, 12 flats, 24-unit buildings, and Jack or Stacy can sort of fill in the holes on this, but in general, the fund that they're launching is really to provide capital to those mom and pops who historically can only afford buildings in weaker markets, but in order to buy buildings in the stronger markets, they historically have not had the capital to do so. And their MEZ fund, which they're launching this year, is to provide that slice of capital so they can go in and compete with other buyers for properties that are marketed, that probably not off-market, but that are marketed to buyers who typically have the cash to go in and buy it, but may not be predisposed to affordable units. Now the entrepreneurs who historically have bought buildings on the south or west sides, if they need to buy on the north side or other communities, they can go to CIC. They can get their first mortgage from BMO Harris. They can then go to CIC for a MEZ loan, and that will give them the additional capital to buy. So I think that is a class of investor that I'm anxious to see to be able to buy in the stronger markets that will help preserve sort of naturally occurring affordable housing, which is sort of that area that CIC has played in since its existence.
So Scott, I'm going to give you a chance just 1 second, but and then we're going to start taking questions. So if you have questions, get them ready, and we're going to come to the audience in 1 second. But Scott, go.
Well, I was just going to, I think the sort of small multifamily, has been a tough one. We've been talking about it at Enterprise for a long time. I think part of that reflects the fact that community banking, is the local lender who can make a largely character-based loan to a local entrepreneur who owns a few units just isn't there anymore for the most part. It is you have the CICs, but it's not everywhere. And so because admittedly what we're talking about with our funds are the larger properties and basically institutional ownership and management by larger operators, whether they're nonprofits or for-profits. And so I think that's a huge area, and of course many of you are familiar with, if you look at where the stock is of this market affordable or NOAA properties, it's overwhelmingly in those smaller buildings.
Well, we do find that we've been able to, and our partners have been able to own those 20 and 40 unit buildings that are in the same sub-market they're already serving. You can't go in by yourself and just pick up a 20 unit or a 40 unit, miles and miles apart. But if you're already in community, we found it's helpful to go ahead and pick those up and add it to what you're managing.
Yeah, I think the point about, and I had written it down, so I'm glad that it came up. The point about the mom and pop, quote unquote, owner really is a critical point. Like CIC, CPC's focus for many years has been that owner class, and I think what we find is that the ability to compete in the market is really challenging. They lack equity, and at least in New York, and not just in New York City, but even in the surrounding Metro New York area, the small buildings are even trading at prices that it's hard to imagine how you would buy those. CPC has customers that have been partners of ours for our entire 44-year history who are long-term generational small property owners who have completely gotten out of the business because of buying buildings. They're not necessarily selling, interestingly. They're continuing to hold and run and manage their properties, but they're not buying more because they can't compete. So I think that continues to be a really difficult challenge in the hottest markets. And that was one of the things that I wanted to just get, like Rachel, I'm a myopic New Yorker, but for those of you that work in bigger geographies, I want to get your thoughts about strong versus weak markets. I mean, we work all across New York State, and New York State has strong versus weak markets. And I think we definitely see differences in the ability to grab the stock and own the stock and preserve it and maintain affordability. We see rising rental markets in every place in New York State, from Buffalo to Brooklyn. The rental market and rents are rising in all of those communities. But I just wonder if you all see a difference in strong versus weak markets, and how do you think about that now as the rental market has changed? And maybe, Scott, I'll ask you to start on that one.
Well, we have in terms of these funds, we have a range in terms of where these properties are, but there's no question that in order to meet our hurdles, that the secondary markets are generally where these properties are.
Better. Yeah.
I would say that they don't. That some are stronger and weaker than others. We're not usually in really weak markets with these. I don't know what it's hard to know. It's hard to fathom. You were saying about
right.
this, people picking up these small properties at ridiculous prices. Like, well, what capital is that?
Yeah.
Where is it coming from? I don't know. Maybe others have a beat on that. But like I said, if you look at the map of where the properties are, it's a real range. But you know, it's particularly with a fund sort of joint venture structure, with third-party investors and so forth. You have to sort of hit a certain hurdle that somebody just with a pile of cash in their pocket, doesn't have to meet.
Yep. So we have about 15 minutes left. Do we have audience questions, comments, thoughts? Sure. I think we have microphones running around somewhere.
So this is an in-the-weeds question for you, Scott. I think you had mentioned about your NOAA property where the financial institution was having a difficulty getting CRA credit. I think you said that you were able to overcome that because of the fact that you were using income to qualify them for the rents. I was just curious of a couple of things. Was the property located in a lower moderate income census tract? And the second part of that was it sufficient that you were using income to qualify them for the rent, or did you actually have to provide the incomes to the financial institution to get the CRA qualification?
So this wasn't specific to one property. It was specific to someone coming into the fund, and kind of how they would evidence that the properties in the fund were meeting the affordability that they were looking for. So it wasn't property specific. And sorry, what was the second part of the question?
The second question was it sufficient? Was it sufficient that you were using income to qualify them for the rents, or did you actually have to provide each of the incomes to the financial institution in order for them to finally get the CRA consideration?
I don't know the answer to that specific question. And we're not, this is not income qualification in the same sense as like, someone's applying and going through the whole certification process for a, say, a tax credit unit or a Section 8 or whatever. This was looking at, are the folks living in this property? Because you're buying properties that are occupied, and are existing, and are the folks living there, within an income range? But I don't know. I don't think we were providing like PII to the regular. I don't know if they wanted to see that. I don't recall exactly how we then delivered that evidence to that investor.
I think we have another question over here.
Hi, thank you for this panel. A couple of things that I heard people say that resonates in New York City in terms about like the owner matters. I heard you, it was Scott talking about where's this capital coming from? Like how are they spending so much money on these buildings, right? Where people are living, low-income people, rent-regulated housing. We've been thinking a lot about the CRA in this manner. Do you have any thoughts about ways to stem this practice? One, to encourage lending to the landlords that you're talking about, which are the ones that are responsible, looking at long-term affordability, and other ways that it might discourage or stop, particularly banks, but also non-banks are making loans or providing capital in this space. So I'm just curious if you've thought about the CRA as a tool on both, in addition to the funds that you have and the nonprofits that you're working with.
I mean, I'll just not really talk about it from a CRA perspective, but from the perspective as a lender in New York. We have a model that we follow, which is about really knowing who we're lending to, seeing their properties, seeing the other properties that they own, what their business plan is, what their strategy is, and we also believe that longer-term debt is better than shorter-term debt. And so we, while we're not always successful, we try to make the longest-term loan that we can possibly make to that owner, because we believe that that's better ultimately for the buildings, and owners that are interested in longer-term debt are more likely interested in longer-term outcomes for their real estate. I mean, I think, look, we do a lot of 30-year fixed-rate mortgage lending for multifamily in New York, but it doesn't have to be that. That's largely for regulated affordable. For the market affordable, naturally occurring affordable, if we can do 10-year terms, 15-year terms with 30-year amortizations, we feel like that's a horizon that is a reasonable horizon for an owner to be taking. We're competing against 3- and 5-year terms with lots of interest only and very low rates and big bullets. So it's a very, you hit on a good point, which is the debt markets are also part of what's driving some of this, because interest rates are low and the product types are shorter term. But we try to get 10 to 15-year terms. We don't always succeed, but we try to get 10 to 15-year terms with 30-year amortizations.
You are competing with maybe lenders that aren't mission driven. So and there are banks that take this seriously and others that don't. And I appreciate the banks that really do. And I'm just curious, again, from a CRA perspective, if anybody has any thoughts on it, because that's what we want from lenders. Honestly, I appreciate that.
I can't really answer it from a CRA perspective. I'll just throw this out there without really any analysis, but one of the things that I acknowledge is that our bank investors in our fund also have buyers as clients who are using their lending resources for other kinds of investment real estate. It's how they kind of understood the real estate that we were talking about and bringing them to the table, and they do want to have impact, but they are private banks, and these are their clients. So it's just one of the things that we balance in working in the space, certainly.
I mean, one thing we find is we don't have any trouble getting well-priced debt. There's a lot of competition out there. When Rafael talked about 3-year debt, it just made my head explode, because that's of no use to me. I'm not flipping anything in 3 years, right? But we do get good multifamily debt with 10-year terms and 30-year AMs, and that works for us. But we have a number of big banks who have invested equity in us, and equity is gold for this. It's what makes the difference in doing it. And equity's hard for banks in different forms. And the more your regulator needs, tax credit like qualification of tenant income for tenants who are not used to providing that and aren't really incented to do that, that's a problem. For the big banks, to the extent that they get capital surcharges for these types of investments, that's a big problem. This should be meat and potatoes investments for all banks, because you need both. But it's hard for every institution we've ever talked with. And some have been able to figure out how to make it work, but others, it's too much brain damage, honestly.
I think we have a question up front here.
Carolina, UC Berkeley. This is for Rachel. Actually, I'd love to hear a little bit more about what cities are doing to actually encourage more acquisition of NOAA when these properties transfer.
So right now we're in an environment in the state of Minnesota where the state isn't going to pass laws that kind of change some of our landlord-tenant relationships. So in terms of tenant protections, it's 30 days that you can give notice to someone and they move out the 30th day. And so that's usually what happens when there's a transaction and the plan is upscaling, and it's in the news every time, and it happens quite a bit right now. And so folks get a notice and they are on the street in 30 days. And so the cities are working with a lot of our advocacy community. A lot of them are really thinking about the tenants, and it's a perspective I appreciate quite a bit because it's not my framework. But the advocates have a slate, and it's a slate of looking across other cities and other states and what can be done by ordinance at city council. So it's everything from, which have not passed yet, but rights of first refusal, notice of sale, longer time frames on some of these, just the notices, longer time frames on the sale. But now one city has passed and another city, both large suburbs, is considering an ordinance that just extends that protection for residents from 30 to 90 days. It's still inevitable. This is a property that's sold for upscaling, but it gives the advocacy and tenant rights groups 90 days to work with people on the next steps rather than 30, which sounds hard. And it's actually, we're having a lot of hard conversations in these city stakeholder groups because it's just 3 months instead of 1. But it's these incremental changes, and all of these cities are looking at their fair housing policies essentially and saying what else is in our toolbox. They are, and they did on the deal that both Carl and I shared. We had, I think, 4 cities total who were involved in that development, and they made a small monetary contribution to the development that made all of the units eligible for tax abatement, which helped us be competitive on the price, and pretty much all the cities are willing to do that and sort of work with the systems that we have. But for now, I mean, without a regional or statewide approach, we're just working with this slate, and every council is sending their staff out to research it, and then they're watching the councils that do pass something, and then they say, well, we'll pass it, we'll see if we get sued. If we don't get sued, we're going to keep going, and that's literally what we're doing, city by city.
The other things that I've seen localities trying to do, one is use code enforcement as a bit of a stick for owners that are not doing the right thing. That can be a tool for localities to gain some leverage in a sale. And then with only 3 minutes and 48 seconds left, opening Pandora's box of, there are also lots of municipalities and counties and jurisdictions around the country that are now starting to talk about are there rent regulation laws that they can pass to govern rent increases. As a New Yorker, that gives me a giant pain in my stomach. But it is something that people are trying to think about as a way to grapple with the issue of affordable properties selling and then rents just jumping dramatically, which is having a real impact on those communities. We have 3 minutes left. Any other? Yeah.
Hi. So one of the things that we've been hearing is that, with unemployment below 4%, there are a lot of sort of smaller towns or rural areas where you're seeing a resurgence of like manufacturing, but that the employers are having a lot of trouble attracting workers because nobody can afford the housing. And I guess if you could talk a little bit about that, if you've done anything to address that or worked on NAAHL deals in some of these areas, that would be interesting.
We haven't done any truly rural deals, but we've done deals in communities where in the last census, they were areas of intense poverty, and by the next census, they're going to be so shiny rich, your head's going to blow off, right? So we have bought in communities that have experienced, we bought a deal in Stockton, California this year. 10 years ago, you couldn't have made anybody in my partnership go to Stockton. Last year, it experienced some of the highest rent increases for rental housing of any city in the country, blowing through the roof in terms of cost. So we look at that. Small rural areas, for us, the ability to do it, we don't have enough, you don't have scale. And so one 20-unit or 15-unit building in a small city, Cleveland, Mississippi, is unmanageable for us unless we can surround them.
Yeah, this is where the small owner, the small building thing really becomes critical. We have actually a lot of experience in New York. We have recently, in the last 5 years, made 2 significant investments in multifamily buildings in a little town called Penn Yan, New York, which is in the Finger Lakes, which is one of these places where industry is coming back because of investments made by the state in the beer, wine, and spirits industry. And there is no housing for people who work in that industry. And so places like Penn Yan, which is a small little town of a few thousand people, are starting to see multifamily properties that have been long vacant, warehouses that were vacant that are being converted into housing. And it's regenerating some of those small communities. So we are seeing that happen in New York and have made some of those investments.
But there's still we need a supply of housing and affordable housing, and these strategies are part of our preservation strategy. But I think in a lot of those places, a lot of those communities, we need to also need to build more.
Yeah, that's right. And we didn't talk about that, and maybe next year we'll do a panel on the fact that this niche in the market that we're talking about, which isn't deeply subsidized and isn't luxury, there's almost nothing getting built new in that niche in this country. And that is an even bigger challenge because of the continuing growth in the rental housing market across the country. And I see Buzz standing there, so that means we're 44 seconds over our time. Let's thank the panelists for a great
Good job. Excellent.